All right, let's get right into it. We're going to unpack the real strategy of the world's most famous investor. And trust me, it is probably not what you think.
You know the popular myth, right? We all hear it. Warren Buffett, he's just a simple bargain hunter, a total disciple of value investing. The story goes he just finds companies that look cheap on paper and, well, he buys them.
Yeah, but see, that's just the opening act. The real story, it's way more interesting. It's about this huge evolution in how we thought, an evolution that pretty much changed the investing world for good.
So to really get where Buffett is today, we've got to go back to the beginning, back to his teacher, the guy who literally wrote a book on value investing, Benjamin Graham.
And you have to understand, this was a huge deal back then. Seriously. Before Graham, most people saw the stock market as just a big casino, a place for speculation. But he completely reframed it. He said, no, when you buy a stock, you're not just buying a ticker symbol. You're buying a tiny piece of an actual business.
And look, if a stock is a piece of a business, well, that means every business has some kind of real underlying worth, right? He called it intrinsic value. So Graham taught Buffett to stop being a speculator and start being an analyst, to actually calculate what a business was worth, and totally ignore the crazy day-to-day mood swings of the market.
And right there, that's the whole game for a value investor. It's all about that gap, right? The battlefield between the market price, which is just all over the place, driven by emotion, fear, and greed, and the company's actual intrinsic value, which is based on real, solid, slow-moving fundamentals.
And this quote, this is the one Buffett lives by. It's the foundation for everything. Price is what you pay, value is what you get. The core idea is simple but so powerful. Price and value are two totally different things. And you know what? Nothing puts that idea to the test like a full-blown crisis.
Which brings us to 1963 and this huge, almost unbelievable fraud that just rocked Wall Street. It was the perfect storm, creating exactly the kind of panic and chaos that Graham's whole philosophy was built to take advantage of.
Okay, so get this. There's this con artist, Tino De Angelis, and he has this brilliant, evil idea based on high school science. Oil floats on water. So what does he do? He fills these gigantic tanks with water, pours just a little bit of salad oil on top, and then gets a company owned by American Express to sign off on it, certifying it as millions of dollars of pure salad oil inventory. It was a disaster waiting to happen.
And the fallout was just immense. We're talking fortunes completely vaporized, 16 companies went bankrupt. And the market, it just freaked out. It reacted with pure, unadulterated fear and just hammered American Express stock because, hey, their reputation was tangled up in this whole mess.
But while everyone else was panicking, just reading the scary headlines, Buffett did what Graham taught him. He did the homework. He literally went out to restaurants, he went to banks, and he just watched. And what did he see? People were still using their Amex cards, they were still buying traveler's checks. The underlying business, the intrinsic value, was perfectly fine. So he ignored the noise, focused on the value, and yeah, he made a fortune. Textbook Graham. But this is where the story gets really interesting. This wasn't the end of his education.
Okay, fast forward to 1972. An investment opportunity comes up that is going to completely change Buffett's entire playbook. And a lot of this is thanks to his partner, the legendary Charlie Munger.
And this quote from Munger, this is a total game changer. It's a direct challenge to Graham's old way of thinking. See, Graham loved what they called cigar butt investing. You find a soggy, discarded cigar on the street, pick it up, and there's one free puff left in it, basically buying a crummy business just because it's unbelievably cheap. Munger said no, forget that. He was pushing for something new, quality, over just plain cheapness.
And C's Candies, this was the ultimate test. They paid 3 times what the company's physical stuff was worth for a candy company. I mean, Graham would have been horrified. This was not a cheap cigar butt. No way. Buffett was paying up, and he was paying for something totally different.
So what was he buying? He was buying what he calls an economic moat. C's had this incredible, long-lasting competitive advantage. It was all about brand loyalty, tradition. People in California, they just love the stuff. And here's the key. That brand loyalty, that was a real asset, but it was an asset you couldn't find anywhere on a balance sheet.
And this chart right here just shows you the magic of that intangible asset. Look at the massive gap. They weren't really selling much more candy each year, just 4% more, but the profits, they went through the roof, up 21% a year. So how's that possible?
Simple. They could raise their prices year after year, and their loyal customers didn't even blink. They just happily paid up. That, my friends, is the definition of pricing power.
So, what's the real formula here? This shift, this evolution from just cheap to quality, it wasn't just some gut feeling Buffett had. And this is where things get really cool, because we can now look at modern research that has actually put the numbers to this strategy, separating that old myth from the mathematical truth.
It was a fundamental change in his mindset. He went from valuing what a company owned, its factories, its inventory, the physical stuff, to valuing what a company was, its brand, its place in the market, all those unique qualities that make it special.
So some financial researchers, a group called Sparkline Capital, they actually dug into Buffett's entire investment history to figure this out. And what they found was that his incredible success wasn't really because of that classic value factor, buying stocks with a low price-to-book ratio. Nope. The data showed his secret sauce was made of two other key ingredients, quality and intangible value. And look at this chart. This is basically the smoking gun. It shows where his outperformance, his alpha, really comes from. The moment you adjust for the industries he tends to invest in, like financials and consumer goods, the whole he just buys cheap stocks idea, it just vanishes. It goes to zero. Instead, his success is almost perfectly explained by these other two things, buying high-quality businesses and businesses with tons of intangible value.
So this is it. This is the key, the real Warren Buffett formula. And this data-backed view suddenly makes his whole career make sense, doesn't it? It explains why he bought Coca-Cola in the 80s, that world-class brand, and it perfectly explains his massive bet on Apple today.
And look, this isn't just some boring history lesson. This way of thinking is universal. And today, in an economy that's so driven by brands and software and ideas, it's more important than ever before. Think about it. A lot of people were totally baffled when he bought Apple, a tech company, trading at what looked like a high price. But he wasn't breaking his rules at all. He was just following the exact same formula he learned from that little candy store. He didn't see Apple as a company that makes phones. He saw a consumer brand with an almost unbreakable ecosystem and just incredible pricing power.
So the big takeaway here isn't just go find cheap stocks. No, the real lesson is to learn how to see what the rest of the market is missing. It's about looking past the spreadsheet, beyond the numbers on the screen, and really understanding those durable, intangible things that make a business truly great. And you know what? That's the real challenge, but it's also the real opportunity.